Good morning, everybody, or rather good afternoon, and welcome to Essentials. My name is Dale Franklin. I'm a co-founder and executive director for Anchor Financial Services, and welcome to a really interesting and insightful topic. One of the questions that I often get posed is exactly how does a fund manager work with an economist? When we look at economists, there's masses of opinions and macro views, and how does a fund manager funnel those views into actually appearing in the portfolio? So today we're going to have an interactive session between fund manager and economist. I'd like to introduce our two speakers for today. No stranger to the forum is Nolan Wapenaar. Nolan Wapenaar is our co-CIO and head of fixed income. He's presented many times to the forum, and I'm sure is no stranger to you. We also have Casey Delport. Casey Delport is our resident economist and works very closely with Nolan. She has a master's in economics, and we expect some really exciting banter between the both of them. Should you have a question, please pose it in the chat function, and I will pose it to the panelists after the meeting. As you know, Essentials does get CPD points, and we will send that to you as soon as we have them. So without further ado, I'd like to hand over to Nolan and Casey.
Thank you very much, Dale, and hello everybody. It's absolutely wonderful to be presenting to you again. Going as Dale explained, I'm going to work through a presentation which has got some sort of interesting economic graphs, snippets, what have you, related to South Africa. I'm going to ask Casey to give us an economist's perspective on the particular graphs, and then I'm going to come in afterwards and explain what these graphs actually mean to a fixed income portfolio manager. So without too much ado, because there are quite a couple of graphs, let's jump into it. And let's start with what is actually probably the most important question. Why do we need an economist within an investment team? If you think about it, economics is a very, very woolly art. I'm hesitant to call it a science. The number of answers you get to any question is almost infinite. And economic forecasts have this uncanny knack of proving to be wrong. So, given all of that, why do we need an economist within the investment team anyway? And over to you, Casey.
Well, that is quite an illustrious way to start off the presentation. And, I believe the best way to explain it, particularly between a fund manager and an economist, is that, of course, Nolan, within his role as a fund manager, he's very much dependent on looking through the numbers, looking through the data, and of course, what does this mean for him, within himself, within the fund, within the performance? That is what he is most interested in at the end of the day, naturally. From my side, economics in the day remains a social science. That's what Nolan alluded to. He does not like the concept, but it's my job to make sure I pick up on the trends and underlying factors that are feeding through onto our funds, to remind Nolan as well that at the end of the day, what drives the economy are the decisions that you, myself, and everybody makes, everyday people, and that's what feeds through into the economy. So to really highlight and understand the social nature and the aspect of what really drives the economy and what that means for our fund's performance. But as Nolan mentioned, I do have a cunning way of often getting it wrong.
Thank you very much. So, from my side as a portfolio manager, what you really are trying to do is to understand the world around you, understand what's going on. And quite often you're faced with things like the government of South Africa has just rebased its GDP. What does that actually mean? What does that mean for us as a person in the street? What does it mean for the accounting numbers for our government? And you need somebody who understands that to unpack the sort of what's going on in the world around you, make it understandable for someone who isn't naturally an economist, and at the same time to allow us to then start to understand the trends that are developing as the world develops, as the inflation numbers move, or as the economy behaves in certain ways. So it's all about understanding what's going on, which then feeds into the thought process of actually building a portfolio. So with that in mind and understanding what's going on, let's kick off with talking about what's top of mind, if you want, and moving into the latter part of 2021. Where do we stand?
All right. So I think in order to properly frame today's discussion, we need to understand the context. And as Nolan mentioned, where do we stand today as we're speaking to you? So as we enter the second half of 2021, after what has been a significant year and a half for people across the globe, the global economy is poised to stage its most robust post-recession recovery in around 80%. Just a reminder, we're looking at around 6% growth rate for the globe across the point of 2021. This is, of course, coming off a low base from last year. But what I do really want to highlight is that the rebound is expected to be uneven across countries as your major economies look set to register strong growth, even as many developing economies are actually lagging. And of course, off the back of this, the key risk to global growth prospects continues to be the pandemic. If we look more briefly at local point of view, South Africa's third wave of the pandemic was always likely to materialize. And of course, indeed, a fourth and fifth wave, we've seen those discussions taking place, given the very slow pace of the vaccine rollout, which notably only started to accelerate back in June. And while we still see these sort of notable downward risks remaining, economic recovery is actually still progressing fairly well. And nonetheless, South Africa's economic activity off the back of this will be patchy, with unevenness between sectors influenced by the various lockdown levels, etc. But on a more positive aspect, South Africa has seen a recent quickening in the pace of the growth-enhancing economic reforms, and notably a strong and committed anti-corruption drive, which supports the view of a longer-term acceleration in economic growth once the distorting effect of last year's base effects dissipates. And that's sort of how we're going to frame the discussion going forward, and these are points we'll be leading to in a few slides, slides time.
Thank you. From a portfolio manager's perspective, what is top of mind? And that is the amount of stimulus and support that has been injected into the global economy. We've seen that over the last year or so. Thing is that support is now going to slowly be withdrawn. We're calling it the US taper, so the tapering of bond purchases as they reduce the amount of support they're giving the economies. Historically, that has been something that's quite bad for emerging markets. Potentially, it puts the emerging market currencies under pressure. The reduced access to liquidity puts the potential finances of the governments under pressure, the economy's under pressure. So we're concerned about what are the spillover effects for South Africa. At the same time, we're also concerned about South Africa's fiscal standing. Basically, the government's cupboard is run bare. They don't have any more money. Debt levels are excessive, and the government's got to manage its way through this in a very difficult time. Can they manage their way through it? How are they going to manage their way through it? And we'll talk about that in the next couple of slides. And then finally, what else are we looking at? We are looking at the middle class of South Africa, which by and large is losing confidence in South Africa. The narrative is very negative. People are looking for confirmation of reasons as to why they should emigrate or financially emigrate. And without a confidence to actually invest in the country, it's going to be very, very difficult for the government to pull the country together to actually rebuild the economy into what it can actually be. So those are the key things that we're looking at from the portfolio management side. Moving across and sort of turning the microscope into GDP growth first, what you've got in front of you is a chart that shows the quarterly GDP growth numbers, or it's the quarterly measure of an annual GDP number. So it's the one-year GDP number. You can see how at the height of COVID, there was a significant hit to the economy. The economy's kind of recovered through that. Casey, over to you.
Yeah, so we did see that GDP increased at an annualized rate of 4.6% quarter on quarter for the first quarter of this year. And the fact is that, despite this being the third consecutive quarter of growth, the South African economy is still 3.2% smaller than it was in the first quarter of last year, so before the COVID pandemic hit. And this is actually leaving South Africa as a laggard in the recovery to pre-pandemic real GDP levels in comparison not only to sort of your more developed nations, but developing nations as well. So the question we now find ourselves in is, where are we now? Where are we going forward? And really the answer to that is we're very much at a critical juncture at this point. So for this year, GDP is forecast to reach around the 4% mark, possibly a slightly bit higher. And from thereafter, it's expected to taper down to around the 2% mark for 2022 and 2023. Now, the problem with this is that typically in the South African economy, material job creation has only occurred when GDP growth approaches around 3% per annum. So with unemployment for the second quarter now sitting at around 34.4%, and more notably your youth unemployment at 64.4%, this just is not high enough. These growth levels are not feeding through to what we need to adjust the multiple social ills and structural constraints we have within the economy. So what do we need off the back of this? The South African government needs to urgently address the structural issues that are preventing sort of the robust and sustainable growth prior to the pandemic. And when I refer to these structural issues, I'm of course referring to the inefficiencies at our ports. That's been in the news headlines quite a bit recently. We're looking at the energy constraints. Everybody's quite well aware with what is going on with Eskom, and of course your service delivery by municipalities. And we will address some of these constraints in a few times because we are actually seeing some notable reforms off the back of this. But for now, overall, we expect the local economy should reach its pre-pandemic growth levels during the first quarter of 2023 or thereabouts. So we still have quite a long way. We've got a few risks playing for either the upside or downside within the next sort of year and a half.
Thanks, Casey. So from the portfolio management side, if I go and Google why invest in emerging markets, the top 5 responses that you get are because emerging markets offer above average or larger economic growth potential. That is a problem because South Africa does not offer that. So as a PM, what you will look at is South Africa and say, but those industries, those sectors, those investments that are more leveraged towards long-term economic growth, it's very difficult to invest in those in South Africa. Which is one of the reasons that a lot of people have actually been investing abroad to invest in opportunities that just aren't available in South Africa. Not all South African investments are bad. I can point to certain shares in certain sectors that are growing. I can certainly point to South African fixed income that's attractive. But it is just more difficult in a slower growing economy. What are we really looking for? We're looking for those 2 things I mentioned earlier. We're looking for confidence. The government over the last decade has burned through a lot of confidence, and they've lost the confidence of the middle class. It's all about getting that back. And that's proving to be more difficult than I think the government originally expected. And at the same time, we are then looking for pro-growth structural reforms. And we've started to see a few of them. We're going to chat about some of them later, but not enough. We need to see more. And, I think everyone's very familiar with what the key concerns are in terms of labor market rigidity, in terms of, a very controlled economy. But without letting go of some of that, it's going to be difficult to actually spur economic growth. Flipping across from economic growth, the next thing that we typically look at is inflation. Casey?
Yeah, so the last inflation print was more of an interesting one. It actually came in slightly below expectations and printed at 4.6% year on year. This is, of course, for July. So what does this print mean? It's one thing to look at numbers, of course, another story to understand what does that mean for the greater economy at play. So really, this latest print shows that overall, the inflationary pressures that we're seeing in South Africa at the moment continue to moderate downwards as expected, as we see these low base effects from last year start to dissipate. I think it's important to remember that these base effects result not only from the fuel price movements, which is obviously, of course, the fuel price is something that all of us like to get pretty excited about, but it's also coming from the imputations of unavailable pricing data during the hard lockdowns of last year. But overall, really, this latest print and the few before, it affirms the idea that inflation in South Africa is indeed proving transitory. This is a theme that we've seen across play out quite predominantly within the US as well. And we still foresee inflation of averaging around the 4.2% up to possible 4.5% mark for 2021. So this means sitting comfortably around the middle of the SARB's target range. And then the big question that we have that feeds off of this, and so I'll pass over through to Nolan, is what does this mean for monetary policy, and specifically for our interest rates and for the market participants as a whole? What does this mean in terms of what the SARB has in store for the rest of the economy? And Nolan always has some pretty strong views on this one.
I do indeed, and we'll talk about the monetary policy on the next slide. But looking at inflation, very much what you've seen is a spike in inflation from the unlock. In other words, from the reopening of the economy a year ago, we were all locked in our houses, absolute minimal economic activity. And as that has been released, it's not fully released, economic activity has come back, and there's kind of a catch-up inflation that's taking place, which is quite normal. What's perhaps more important, though, is if I look at the last three inflation prints, there were 5.2%, 4.9%, 4.6%. Very, very much a downward trend is establishing itself. So you had the spike of inflation from the unlock, and now inflation is normalizing back to where it historically was. Actually makes a lot of sense for inflation to do that. As Casey said, inflation is probably going to settle around the 4.2%, if not lower. You can see core inflation's at 3%, for example. And what that really is saying to me is our economy is soft. Consumer spending is still limited. Consumer activity is still limited. You had the revenge spend of a couple of months ago as we came out of unlock, but that's come and gone. And now we're in a situation where, it's just sort of a muddle along economy, and you're seeing that in softer numbers throughout. So from that perspective, outlook for inflation is probably lower than people expect. So what does that mean for interest rate hikes? And what we've got here is a chart that shows you the number of hikes that the market is pricing in at any point in time. So if we look at the bar chart on the left-hand side, it's sort of 1 times 4, which we're going to ignore because there's no real number there. 2 times 5, I'm going to ignore, but I'm going to talk about 3 times 6. So the 3 times 6 is basically saying that in 3 months' time, the derivative market expects interest rates to be a little bit less than 0.2% higher than today. Basically, what they're saying is in 3 months' time, there's effectively about a 50% chance of one interest rate hike. Over time, you can see how the market is pricing in incrementally more and more interest rate hikes. And the number that's particularly interesting to me is probably about the 18 times 21, second last, which is going for about 1.4%. So what the market is pricing in is that over the next 18 months, so basically towards the end of next year, we should have about 1.4% worth of interest rate hikes. That is about 6 interest rate hikes of 0.25% each. That's where the market is coming to. That's what this graph is telling you. But Casey, how should we think about this?
Yeah, from a pure economic sense, this is where perhaps the idea or the practice of economics really differentiates from what the market leads out if you look at the graph in front of you. But from the sense of the economy, there really are no factors or drivers at the moment that really say that the SARB or should put pressure for the SARB to hike. When you take a step back, when we look at the more muted inflation prints that are coming out, we just alluded to, we have chronically high unemployment. And on the back of that, the average South African consumer is coming under significant pressure at the moment. So from that point of view, why should the SARB hike anytime soon? There's nowhere here that stands that the economy should feed through. If anything, there perhaps should be more of your outside factors, players coming in from the US and the Fed. But again, that's where often Nolan and I come to a slight disagreement on that. But from the pure economic sense, there's nothing within the South African economy screaming to say to the SARB, we need to hike, the economy is in overheating. Perhaps in sense, actually the quite opposite, where we believe that off the back of that, the SARB might actually keep rates lower for longer than what the market is actually initially anticipating.
Thanks, Casey. Very similar views on this. In essence, the market expects 6 interest rate hikes between now and the end of next year. As I sit here, I see inflation coming down, 4.6% last print. Next print probably below the midpoint of the Reserve Bank's target band. I'm seeing soft wage growth. I'm seeing negative employment growth. I'm seeing an economy that's stuck in the mud. It just is not an environment where you are going to chase interest rate hikes. And actually, the SA Reserve Bank's Deputy Governor said as much on a sort of investor webinar a couple of days ago, where he said that, yes, we will slowly raise interest rates to neutral, but it's going to take far, far longer than people realize. And what that is saying to me is that you're not going to get your 6 rate hikes. What does that mean to me as a portfolio manager? It means potential capital gains. If the market is pricing in 6 interest rate hikes and we get less, there are capital gains on bonds. So I'm looking at this and thinking short-dated bonds are potentially set for further capital gains beyond what we've seen in the last month or two, where they've already started pulling back interest rate hike expectations. So for me, this is actually an investment opportunity starting to manifest. Moving across to the current account now, what we're talking about is basically the amount of dollars. Let's keep it quite simple. That the nation is earning through exports minus the amount of dollars that it pays away for imports, and the trade balance is whether or not you're accumulating dollars or whether you're actually spending dollars, net needing to borrow dollars to fund yourselves. What is important on the chart, and I'm just going to talk about the chart on the left, which shows it as a percentage of GDP, but you've got the trade balance, which is the bars, and you can see how South Africa's trade balance was actually positive, but relatively modest. And in the last year, it's kind of gone berserk, where the trade balance has been very significantly positive for South Africa. And another way of measuring it is the current account, which the trade balance forms a large part of, but you add in a few extra things like dividend flows, offshore investments, etc. And the current account balance has also turned significantly positive. So that's got quite a profound effect for South Africa. Casey?
Yeah, so the current account data has really been quite an interesting one to be tracking this year. So if we compare to our outlook at the beginning of the year, or rather the outlook for the greater market, actually, the Q1 current account data has actually come in better than expected. And we have a surplus widening around 69 billion to around 267 billion. So relative to GDP, the current account surplus has actually increased from 3.7% to 5%. And what we're seeing driving this is that the surplus was supported by an improvement in the trade surplus, as the solid export performance of the recent quarters has continued, and the country's terms of trade, which Nolan alluded to in a moment, has vastly improved for 7 consecutive quarters now. We are also seeing that the terms of trade may provide even more support to the trade and current accounts in the second quarter of this year, more so than it even did in the first quarter. But thereafter, I believe it was likely then hit a peak, at least from a terms of trade perspective. And overall, we believe that the merchandise trade balance will continue to be supported by sort of firm commodity export prices that we saw in June, and of course, improving global demand. But from there on out, and we started to see this play through, we look at some of the sort of key commodity prices, such as your rhodium, your iron ore, etc. But yeah, from there on out, as we move further into the second half of the year, it is starting to begin to taper out as the sort of commodity cycle slows. And this does have certain, especially fiscal effects to play out, but we'll allude to that in a moment. But overall, we foresee a smaller but still meaningful current account surplus in the second half of this year. And this, of course, will remain supportive to the rand. And from there onwards, Nolan, I'll pass to you because I do know you enjoy talking about the rand. It is your speciality at the end of the day.
So let's talk about the rand. Thank you, Casey. What Casey said was that in the first quarter, the current account surplus was, I think, 280 billion rand, give or take. A quarter's got 3 months in it, so divide that out. It's, let's call it 90 billion rand per month of positive current account. What does that mean? It means that foreigners have had to buy 90 billion rand a month of rands. They've sold dollars and bought rands, to pay for the goods that they are buying from South Africa. That is a massive amount of buying of South African rand that is taking place. And no wonder that the rand is actually being quite strong, with foreigners needing to buy, that amount of money every month. As long as that persists, the rand is going to be well supported. So from that perspective, as a portfolio manager, the first impact it's having on me is I don't really expect a major blowout in the rand. I think that the global environment in which we are will keep the rand volatile. However, as long as we are exporting this amount of platinum group metals, what I expect to see is that the rand will remain well supported, sell-offs will be relatively mute, and the rand will recover. So we continue to be in a positive rand environment. The next thing I would say is that when I look at the current account, it's positive for good reasons and bad reasons. The fact that we are exporting commodities is a good reason. It is great for South Africa's economic growth. However, the other thing that is taking place is our import volumes are down a bit as well. And we're not importing as many goods and services as we could previously, partly because there is blockages in the supply chain globally. So, for instance, importing motor cars is quite tough. You can't get motor cars at the moment. But at the same time, we're also not importing things because a lot of our consumers don't have the money to spend. So it unfortunately is slightly symptomatic of a soft economy, but at the same time, it is very, very supportive for our domestic currency and for the outlook for South Africa in the near term. Looking at all that, though, one of the biggest changes over the last while has been the cabinet reshuffle. By and large, a cabinet reshuffle has been met with somewhat positive response. I don't think it's been fully positive. I think that you do see a lot of familiar faces in new places, if you want, and not a particularly deep bench of ministers who can come in and replace the ministers who have been underperforming. And equally, the ministers who have been underperforming have kind of got lesser roles, but definitely haven't been given the boot as such. So from that perspective, kind of mixed feeling. From an investment perspective, our new finance minister, Enoch Godongwana, is obviously quite a key development. And Casey, what's your first take on our new finance minister?
Yeah, I believe, for finance ministers is always rather a contentious, topic across the board. And I think any form of change in leadership will, of course, inject a level of uncertainty regarding the path that will be taken. But that being said, our new finance minister has demonstrated that prior to taking up this sort of new mantle, that he does understand the dangers of increasing expenditure, particularly on current expenditure items such as wages, social payments, etc. He has been quite vocal about that in the media, and he's really aiming, without sort of generating a higher and more sustainable revenue flow based on, moving the country to a higher and sustainable growth path, and not through higher tax rates. And that's key. And I think that's what a lot of market participants will be keeping an eye on. But nonetheless, he is a relatively unknown to the markets, and he will have to work to persuade investors, both domestic and foreign, of course, that he can help steer the economy in the right direction. And I think that's where my sort of sum totals. It's a really big if at the moment. It's a wait and see story to see, really, can he keep a tight belt on expenditure and not, spending out that really rich revenue windfall that I spoke to a moment ago, stemming through from the current accounts and our exports, etc. But Nolan, I'll pass through on to you because I know this has been a heated topic.
So I'm lukewarm on our new finance minister, to be honest. And he came in very much as an unknown. One of the first things he did, which was very smart, was he set up an investor call with the major investors, asset managers in South Africa, and we could dial in, and he didn't take any questions, but he gave a bit of a sense of his way of thinking. The first thing that I would note from that investor call is he was at absolute pains to invoke, the memories of the good old days when the economy was improving. Don't forget that when the ANC inherited the economy way back in the 90s, it was in pretty bad shape as well. Government finances were in bad shape. There was a lot of repair work to be done. The repair work to be done now is greater than it was. I'm not going to deny that. But he was at pains to invoke memories of the repair work that was done previously and the policies that applied. He must have mentioned Finance Minister Trevor Manuel like 6 times or something in his opening remarks, just to try and invoke the memories of the policies that worked last time the ANC found the economy to be a bit of a mess. That being said, what he did say, which was very telling for me, was that from his perspective, the policies and the direction of the finance ministry under Minister Tito Mboweni were not sort of hatched in isolation and actually were endorsed by cabinet. They were actually developed in conjunction with many of the other ministers in the sort of economic unit, if you want. So from that perspective, he does not expect to see any changes in the direction of policy. He doesn't expect to see any changes in what is being planned. But instead, the way he's basically outlined it, what we've got is a new guy with his hands on the steering wheel, but the destination continues to be where it was previously. So he's come in with very much a positive message, and I think that's the message that the market wanted to hear. Where am I lukewarm? Well, to be honest, he is an unknown entity and talk is cheap. We have seen many finance ministers who have made lots of promises that have completely just been forgotten. So the time that the rubber hits the road is on the 2nd of November when we have the mini budget from the finance minister. That's when he needs to actually stand up and start to deliver the hard decisions. And it'll be very, very interesting to see how that plays out. What does that mean to my investments, to the investment portfolios? At the moment, there is an Enoch Gondwana risk premium that is being applied to South African assets. He remains an unknown entity, and until he's actually demonstrated not only that he's going to talk the talk, but that he's really going to walk the walk, that risk premium continues to be there. If he does if he does walk the walk, and I think it's not that far away, a couple of months, we're in November, I think that there is a possibility for South African assets to rally a bit on the back of pricing out that risk premium. So potentially an opportunity as long as you believe he is going to deliver. But where is our specific concern on the finance ministry, on the government's finances, and delving into the government's finances? What we have here is a chart that shows in the dark blue bar the tax collection for each month this year, and last year is the light blue bar. I draw your attention to the sort of May, June numbers where tax collection is significantly higher than it was last year. Partly that's a function of the lockdown last year, meaning tax collection was lower, but partly it's also a function of the commodity cycle, meaning that our mining houses are seeing super profits, we're seeing super dividends from the mining houses, and National Treasury is collecting a super amount of tax. This is like a windfall gain for our government, and our government has gotten incredibly lucky at a time that they really need it. They've got excess cash inflows. Casey.
Yeah, so what we're really seeing materialize thus far is that, as we see indicated quite clearly there on the graph, is that South Africa's tax revenue collection for the fiscal year of 2021-2022 is on track to be substantially higher than originally budgeted for, as a result of some particularly good results from resource firms, which have benefited, of course, from the high commodity prices we've alluded to, and a rather robust recovery in export performance. So what this has led to is around 58 billion better than expected financial year sort of 2021 tax revenue outcome. And this, of course, bodes well for the fiscal outlook. I think it's quite simple and straightforward. But off the back of this, we have seen government's recent announcement of the COVID-19 pandemic and the Unrest package we're seeing coming off the stemming of July, which explicitly, of course, increases the expenditure ceiling by around estimation of around 31.2 billion for this sort of current fiscal year. This package, of course, as a reminder, just comprises of the resumption of social support through the COVID-19 distress relief grant, the extension of the TER support, support to ensure that Sasria can meet all its obligations in the wake of the recent unrest, as well as funds for uninsured businesses affected by the unrest, etc. It's a rather large package. What is important to highlight, though, is that the anticipated revenue windfall, which I alluded to a moment ago, actually still exceeds the increased expenditure, and alongside a slightly better growth forecast than what we were seeing initially towards the end of last year, beginning of last year, this extra expense at the end of the day should be covered between this. It is worth noting, though, that most of this improved deficit actually stems from, as I mentioned, improved revenue, thanks to these large in part to the mining sector taxes. And these gains will not be indefinite, and that's what we need to highlight. It will start to run out at some point. And at the back of that, we do believe that there is a significant risk to the debt projection should government choose to rather align expenditure to revenue, such as the fact that the deficit is unchanged relative to the February 2021 budget. And such a strategy could lead to South Africa's expenditure profiling continuing down to the same unsustainable path that we saw prior to the pandemic. And of course, a lot of this rests now with our new finance minister, if he can hold sort of the tight reins on this. But yeah, that's my perspective. I don't know if you want to add on to that.
So the windfall tax collection that we've seen, I think you mentioned 38 billion when you were chatting there. Think about that. That's a pot of 38 billion rand sitting in a bank account under control of politicians. And this big pot of money is like candy to my children. When there's a big sweet jar on the table, my kids sit there and they salivate and they start strategizing about how to get their hands on those sweets. That's what this is to these politicians. They're all sitting there figuring out how can they spend that money, either on themselves, because it's kind of a lot of money to spend on yourself, or alternatively, if you're a bit more ethical, how to spend it on your particular area of government, be it development or roads or whatever it is. But that is what's going on. The thing is that this pot of money is not going to be there for long. It's not going to continue to, South Africa is not going to continue to get lucky. And we need to be very careful to make sure that we don't create a lot of programs, social programs with this money that become unsustainable in a year or two's time. This is the biggest challenge for our finance minister, who's got to sit there and guard this pot of money that all the politicians are pointing to and salivating over, to make sure that this money is actually applied for the long-term good of this country, some of which might well involve temporary grants. I think it was absolutely necessary, but a lot of which also actually getting our finances in a long-term sustainable position would put us in a far, far better stead. So this is the challenge for the finance minister, and this is what we're looking to see how he deals with this in November. Pulling across, though, that then translates as government debt. So our government has been very debt hungry for the last decade, and we've seen debt levels sort of slowly increase and then spiral out of control. And what we have got here is a chart that shows the expected debt level as a percentage of GDP as forecast by the government in November last year, which is the light blue line. And then the dark blue line was the forecast as at February this year. And how that's going to develop over time. Over to you, Casey.
Yeah, I don't think I have much more to really illustrate here, other than you can see the strongly more positive position that we are in back in February when the government and Teal provided this last sort of forecast coming through from there. So really sitting in a much more positive situation. And this really sort of serves to further underline the importance of not overspending this revenue windfall that we've seen, and to keep feeding that in to get our debt levels lower. Off the back of this, what really will be key for us is the medium-term budget speech coming up in November, and to see sort of these updated forecasts coming through from National Treasury, and to see exactly where that sort of debt trajectory is going forward. So all eyes really are sort of turned onto the finance minister come that very important November speech.
Thank you. So from my perspective, maybe the first point to make is that the numbers look less scary today than they did last November. And in fact, if you apply the tax collection numbers that we've seen minus, the amounts that haven't necessarily been spent, we would expect that the government would actually beat this budget anyway, and that the numbers would be a little bit better. So from that perspective, there is definitely some improvement, some achievements taking place, which give us confidence, give us a little bit of confidence. There are 2 points I do want to make, though. The first is that those lines continue to be upward sloping. That means that we haven't yet brought our debt under control. We're just accumulating debt at a slower pace. It is vital that at some point these numbers either come sort of flatten out or ideally start to come downwards again as we bring our debt under control. Therefore, yes, there is some improvement, but we're not there yet, and further structural adjustment is going to be necessary at the government level to bring this under control. So we're watching to see how that gets dealt with in November and how the finance minister deals with it. The other point I want to make is the point that's actually in the business day today, that the government has just rebased its GDP numbers. And what the government does is about once every decade, it'll actually go out and look at the economy and say, what is our GDP? And it'll go, oh, we forgot to count a particular industry. Typically, you have new industries that come up. So like a couple of years ago, the cell phone industry became a new industry in the country. As technology made cell phones available. The government wasn't counting that in GDP, and then when they do their once a decade sort of catch up, they go, oh, we need to include that. So they'll bring it into the sort of counting net, and as a result, your GDP is actually bigger than you realized. Quite normal. All the countries do this. The adjustment of about 10% is also actually kind of in line. It's what South Korea did as an adjustment as well. So very, very normal. Thing is, a bigger GDP number equals a lower debt to GDP. So when our finance minister arrives in November, his debt to GDP number is probably going to be between 70 and 71%, significantly lower than what we've seen here because of just a bigger economy, because there were some things we weren't counting. That is good news on the face of it because the numbers are less scary. However, the interpretation of that is what we're watching. One interpretation, which would scare me, is, we got lots of time to fix this. Look, we can grow our debt further still. Doesn't really matter. That would scare the heck out of me. The other interpretation would be, hey, South Africa got lucky again. This is fantastic for us, but we've still got hard work to do here. We need to get this below 50%. If that is the interpretation, I think it actually positions South Africa very, very well. So we're watching this with bated breath to see how it develops in the November budget. I saw one question on this, and it's the green elephant in the room. It is the government's green paper on social security and retirement reform. Casey, over to you.
Yes. So this one was definitely one that I think they got a few people quite, I don't know if excited is the right word, more aggravated than anything else. So what we're seeing of this, it's just worth bearing in mind that this is just a mere policy proposal. It's still at the green paper level. Which essentially means just open up to discussion. The government will be running a discussion basis off of this up until December, I believe. If for some reason it is pushed through, it will then evolve into what we call the white paper stage. And from there onwards, if it's thus then approved again, that is sent to Parliament under debate, discussion. We know how long those processes can be. It would then be put into a sort of formal policy perspective of the government or of the ANC. But we are a very, very long way away from that. And there was, of course, a lot of contention when this paper came through, hence why we dubbed it the green elephant in the room. So this proposal overall includes a variety of wide-ranging reforms, with the sort of key one, I believe, being that the requirements of employees to sort of contribute around 8 to 12% of qualifying earnings to a new government-managed fund, which sort of received the most attention. And I think any fund manager, especially one that operates in the pension fund, this is a kind of policy proposal that would naturally, of course, keep you up at night. But it's worth pointing out that just a week later, the National Treasury actually came out and confirmed that the paper was not, in fact, government policy, nor has it been approved by the cabinet or even tested against sort of current fiscal and tax policies. So essentially, for government speak, they came out against it quite harshly, sort of indicating the line that this, will not sort of be taken going forward. But I think before sort of carry on from there, Nolan, I'll pass through to you because I know this one got you especially triggered when it came out.
This did indeed get me especially triggered. So I read an article on this, I think it was on News 24 in the evening, one evening, would have been the evening of the 18th of August, I guess. And the blood drained from my face. I felt like someone smacked me in the mouth and I was like, what the heck? So after reading that news article. One grumpy night later, next morning at like 5 a.m., I went and downloaded, actually technically Casey downloaded, emailed to me the actual 89 pages of the proposals, and I sat and read them. Having read them, the first comment I would make is that, there are probably 10 proposals in the green paper. 9 of those I'm actually okay with. It makes a lot of sense to streamline things. It makes a lot of sense to do things simpler. It makes a lot of sense to standardize things, to reduce the costs of managing social grants. Heck of a lot of good stuff in there. But unfortunately, there is one perler, and that perler is that, forgetting all the nice gentle talk, the government would like to expropriate everyone's pension funds. That's kind of what it really reads like. A minute ago, I was saying that, the ministers are all sitting there salivating over this pot of 38 billion rand and how to get their fingers on it. Just imagine creating a pot of a trillion rand and what the ministers are going to be doing to getting to access their fair share of it. Absolutely frightening thought. It is absolutely frightening that the discussion is about effectively nationalizing the asset management industry. I mean, that's what it boils down to. It's softly worded and euphemistically put, but that's horrific. So very clearly unworkable, and it'll create complete pandemonium. The way we look at it is, firstly, I would love to see the other 9 aspects of what's proposed in this document going through. I think they're good for the country. The actual one thing that can't go through is the sort of pension reform as it's put out there. Long and short of it is that 2 things have happened since then. I think Casey spoke to one, which was that this was created in isolation by the Department of Social Development. And the Department of Social Development is not prone to rational economic thinking. Therefore, it's to be expected that they maybe just haven't quite got it right. And that's why it needs to be tested against the rest of government. That's why it needs to be tested against Treasury and the economic cluster, etc. The economic cluster was very quick to come out and say, guys, this is just a million miles from where we're going. Terribly sorry. It's a great discussion document, but understand, that this isn't policy, and the social department might want to do this. But there are a whole host of other challenges for our economy. The other point I would make is, let's not lose sight of the fact as to what's happening politically in South Africa. So what you've got is these 2 factions that the ANC wants to pretend don't exist, but they do exist, which is, effectively a bunch of thieves masquerading under the banner of RET, and they're missing the good old days when money flowed freely. And then you've got actually some people whose hearts at least are in the right place in terms of improving our economy and our country. The RET brigade has been on the back foot, we've seen Asman Gashele sort of effectively being marginalized, suspended from the party. We've seen other equally unthinkable developments that have put the RET brigade under pressure. It is absolutely plausible that in order to create a bit of unrest, a bit of shockwaves for the powers that be, that they would have put out something that's actually quite ludicrous and that would have drawn all of the comments that it did. So it potentially should be seen as a bit of a political gambit, which is good, because as far as political gambits go, it was probably quite a weak one compared to some of the other things we've seen, and therefore it says to me that the RET brigade continues to lose power and lose impetus. But at the same time, it was just an unfortunate shakeup for many people. The reality is that most of the proposals in here aren't even new. This was something that's been drifting around since 2004, and it was just an opportune time to sort of shake things up a bit. I wouldn't read too much into it, certainly for the next decade or so. It's just not workable. So pulling it to a conclusion, Casey.
Yeah, I think the key points I'd like to make here before I pass it to you, Nolan, to sort of conclude fully, is that off the back of these sort of policy proposals that we see now that will keep, I think, anybody who's in the market awake at night, as we alluded to, is that we have seen some sort of really positive news aspects coming through, especially on the reform process. I alluded to at the beginning of the presentation about strong anti-corruption drive. Everybody's seen that driving through. We're now finding ourselves in a far more positive position than I ever thought we would have, say, about 10 years ago or so. And we're actually seeing the corruption elements come through to the forefront, and we're actually seeing action being taken from there. But from a particular economic standpoint, what I would like to highlight is the strong sort of reform measures that we're seeing aside from the corruption drive. So, for instance, for last week, we saw that, while a positive move, the gazetting of the latest amendments to that Section 2 of the Electricity Generation Act, that initially generated some uncertainty amidst some sort of ambiguous wording. What we're seeing now is that this amendment was revised last week to sort of address some of this uncertainty. And this improved sort of latest version makes it clear that firms can now generate their own power, and they will be able to sell it on to multiple customers. And this is, of course, important in de-risking sort of your self-generation projects. And overall, what does this mean? We can start finally generating some self-power. This lowers our reliance on Eskom. This has been a very, very long road to get to this point. And I can underline the importance of getting the power situation in South Africa under control, and what this means for the whole economy's sort of growth prospects, really. In our other reform news, we're sort of seeing Transnet announce plans to invite private sector proposals for investments in some of South Africa's major ports, namely Durban, etc. And, it's still very early days, and it will likely take years for any investment to really materialize. But the apparent move to sort of greater public-private partnerships to sort of finance infrastructure investment really is sort of a welcome move. We're seeing a much more open-mindedness approach from the government in certain aspects, barring the sort of previous policy proposals that we've mentioned. And this really does highlight the need that government is aware that it does need private sector buy-in and expertise to start getting the economy on the right track. So it's something that we've been calling for many, many years. And we are beginning to see the sort of beginning of this journey start to materialize. And to me, that really sort of underlines the more positive aspect that we did not only see at the beginning of this year, but previously as well. Nolan, I'm not sure what you want to sort of add on that. I'm just being conscious of time as well.
Thank you very much, Casey. So South Africans are inherently negative. I think it's just part of our DNA. A year or so ago, there was massive negativity because of our lockdowns, because we had soldiers on the street, because you had to just emigrate to Australia to avoid this. So Australia's got draconian lockdowns and soldiers on the street. Actually, it's just South Africans are often looking for anything that confirms their negativity, and you'll interpret it what's going on that way. If we take a step back, though, and we actually look at South Africa, there are certain things that we just do right. We won the Rugby World Cup. South Africans just set the under-20 4x100 meter world record, relay world record. So, we're great at sports, but there are also other things we're doing right. 3-4 years ago, we'd all stand around a braai or whatever it was, and you'd sort of laugh that you'll never see you'd never see a politician in prison. Jacob Zuma will never see the inside of a prison cell. That's happened. and you lose sight of the things that we are slowly doing right. Things move slowly. But truthfully, if we look at South Africa since the ANC came to power and we ousted the apartheid government, there've been some big victories. In dollar terms, our people are actually 1.5 times better off than they were. GDP per capita is 1.5 times higher than it was when the ANC came to power. We've built 7 million new homes for people. That has been a massive sort of social upliftment. Our black middle class is 170% bigger than it was previously. And, from that perspective, there are a number of things that we're doing right. But perhaps the most important is that the government is now fighting to do things correctly. And, when we speak to companies, when we speak to corporates, when we speak to business, the sense we're getting is that, government is starting to move closer to business again. They're starting to actually get dialogue going, and businesses are closer to government than they have been in the last decade. When the government was being run by a different bunch of people, and this is enabling business to have a say. So Casey mentioned earlier that the Eskom power proposals were revised because business wanted certain changes, and the government heard business. And as this takes place, it's gradually going to build that confidence that we need. It's not going to be an overnight event, but there are seeds of opportunity, potential seeds of positivity that so easily get overlooked. I'm not naively optimistic. There is a lot of risk. There are certainly things we need to be aware of. We are aware of these in portfolio construction. We definitely advocate for, having the right amount of investments abroad on top of investments in South Africa. But it's not, South Africa is not a failed state, and there is definite reason that we can still see things come out positively. So overall, we're sort of guardedly optimistic as we sit here. I'm going to end it there because I know I've rambled on a little bit longer than I should have, and I'm going to hand it across to Dale for any questions, please.
Thank you, everybody. If you could please, if you do have any questions, write them in the Q&A now. I see a few people have raised their hands, and if I could ask you just to populate that quickly in the Q&A, and let's get into some questions. So I'm going to address these questions to the team. And the first question is around the recent social unrest we've seen, and whether that social unrest has impacted your view on the long-term outlook on South Africa.
Nolan, do you want me to take this one?
Yeah, go for it, Casey.
Yeah, and I was anticipating a question of this day just sort of coming through. So I wouldn't say per se it has necessarily changed our outlook sort of going forward. The recent unrest is really just served to highlight the undercurrents that sit within our economy. I think a lot of us can sometimes be numb to the facts for the day-to-day realities of a lot of sort of average South Africans. And this recent arrest just goes to show sort of the importance of government addressing those structural challenges that we've alluded to throughout this entire presentation. So if anything, it's really just served to perhaps wake up or really open government's eyes, and if they do not do something soon and make a wide range of reforms and long-term issues, not just addressing the short-term sort of gains, the situation will start getting messier. So essentially just really serve to highlight the underlying currents that actually exist in the South African economy. Nolan, if you want to add on more to that.
I agree with everything you said. The first time I was involved in Unrest was actually I was in London for the 2011 riots. Honestly, those were more scary to me. I think those were more vicious. I think there was a definite stronger attitude of actually doing physical harm to people, whereas this was by and large sort of wanton destruction of property, but it didn't transgress into sort of as much violence, against humans. So maybe the point I'm making is that unrest does happen everywhere. It's interesting. Australia has actually had to bring in laws a couple of years ago that says if you are rioting, your sentences are far higher from the courts if you were rioting with a mask to try and avoid detection. So actually got no rioting with mask rules, which didn't work well in COVID. But this is a phenomenon that you're going to see from time to time. And South Africa had a very scary, a very significant, a very traumatic event take place. How do we see it? Actually, it kind of worked out more positively than I thought. So you had a lot of disadvantaged society protecting businesses, protecting their incomes, protecting their jobs. You had people saying to the writers, no, this isn't acceptable. You had a far stronger adoption of law than I was anticipating, actually, and an embracement of, civil obedience. From people who I didn't expect it. Who would have thought that the taxi drivers would all sort of protect shopping centres? So from that perspective, there are some positives to be taken, but yes, that is a scary event. Does it affect my long-term outlook? Probably not. I think it's crystallized for the government very clearly that the economy needs attention, that unemployment needs attention. Hopefully we see sensible policy from that, but it's not something in isolation that would necessarily derail our perspectives on South Africa.
Thank you, Nolan and Casey. What is the difference between headline inflation and core inflation in relative detail?
All right, I'll grab this one because I know Nolan will pass it to me anyway. So basically, core inflation excludes the more volatile items or categories within your inflation. So that's typically your food and energy prices, and your sort of transport in that as well, just to show you sort of your more baseline that runs through the economy. Headline inflation includes these more volatile categories. So simply, why do we look at core inflation as well as the headline number? If we strip out these more volatile categories, it shows us the sort of the more underlying trend within the economy. And from there onwards, I can sort of pull, is this particular price mover more of a transitory or more longer term, where again your more volatile items tend to sometimes skew the numbers. So that's why we look at both.
Thank you, Casey. The commodity cycle contributed largely to the favorable current account and support to the currency. We note quite a drop in demand mainly from the East for crude oil. How long do you see the benefits of the commodity cycle continue? This is a lovely crystal ball question for you, Casey and Nolan.
Yeah, it's a contentious one, Nolan. I think I'll pass it through to you. Give you a chance.
I get the tougher questions. Okay, so the last commodity cycle lasted 7 years, actually, if you go and look at it. I think this one's shorter. The truth is the East, China specifically, is under economic pressure at the moment. We're seeing, a slowdown that's more significant than people expected. I think part of that's the regulatory reform that they've just done, which has had some sort of blowback on them as well. The thing is that China's response to this is generally to put stimulus into the economy, to stimulate the economy. And you've seen the first signs of this. So they're pushing interest rates lower. They're putting pressure on people to borrow money at lower interest rates. And that's stimulus. The other aspect of stimulus is that China tends to take a big construction machine, go out there, build roads, buildings, cities, and what have you. When that stimulus comes through, that surprise, if you think about it, is probably quite positive for things like iron ore, which is a key, a key metal in much of the construction that China tends to use as stimulus. So potentially, oil demand less, yes, absolutely. But I think it's not impossible that we see construction metals, copper, iron ore, etc., getting well supported by China. The other part of the commodity boom has been from non-China sources, specifically electric vehicles, certain almost historically byproducts of platinum mines are very useful as catalytic converters and as for use in batteries. And as a result, these, the trends that we're seeing in the economy could actually continue to push for a while as electric vehicles continue to be supported globally. So I don't think that the commodity cycle is going to end tomorrow, but I think that there are reasons to think it'll continue for at least a reasonable while. But I do think it'll be shorter than the last one.
So, final question for today. We've recently seen some improvement in the balance of payments. How much of this is due to simply a strengthening rand? And should we continue to see debt increase, could we see another downgrade of the credit downgrade later in this year?
Casey,
shall I start off and let you sort of carry through on the rand side? All right, I'll just start off with the credit ratings and just provide take a step back and a bit of a backdrop there. At the end of the day, the rating agencies and Moody's in particular, they are extremely data dependent. They rely mostly on the numbers to sort of pull through their decisions. And they, much like the rest of us, are very much in a wait and see moment. I think the real key factor actually at the moment is to see how the medium-term budget speech plays out in November and the reaction sort of from there on out, and to see those debt numbers indeed sort of feed through. That is one of the key elements that you're correct, that the credit rating agencies are monetizing, but they're very much sort of on a wait and see. I believe the sort of factors that we've sort of spoken to in today's presentation will sort of guide a more positive nature towards the rating agencies. They are looking for sort of a stronger fiscal stance, and so far, and obviously a lot of it's still open-ended, this has fed through from there. I think also another element to the question, something more on the rand. Nolan, I'm not sure if you want to take
let me repeat that question. So whether the improved balance of payments is simply an effect of a strengthening rand rather than things improving?
I believe it to be a bit of both, actually, to be honest. It's not just a case of a stronger rand. The factors that we've spoken through before, this increased win for a better debt trajectory, the stronger fiscal stance, that has been feeding through onto the balance of payments, albeit slowly but surely. And then, of course, you do sort of have the element of the stronger rand kind of playing through from there. I'm not sure if you want to expand on that.
I think your rand comments are fair. I think it is definitely a bit of both that we're seeing come through. There are definite improvements on the ground. I think there are definite sort of swings in terms of, the world is buying certain commodities right now, and we have a lot of it. I think, we're importing less just because we're consuming less because we can't afford it. And it's all playing out, as such. And then obviously the rand movement impacts us quite a bit as well. Where I do want to comment, though, is just on the rating agencies. And the point I'd make is that the mindset of rating agencies is still negative towards South Africa. They are looking to downgrade. They're looking for reasons potentially to downgrade us. So where we're at is we're probably in the right peer group at current ratings. So, a lot of the downgrades have taken place. And what they would need to see is some further slippage, either weaker fiscal numbers or basically a government budget that just keeps accumulating debt. And I think that potentially would trigger a downgrade. So, the downgrade cycle continues, but I think we're getting to the point where it's going to continue at a far, far slower pace. So I don't think that there are imminent downgrades. I know there are one or two analysts who are calling for a downgrade in November, December. I just don't see it. I think that our debt levels are probably better than we saw a year ago. Certainly the forecasts are better. And as long as we see a continuity of policy, I think that the rating agencies will be quite patient with South Africa as we work our way through the mess we're in.
Well, thank you, everybody. We are very over time. Thank you all of you for giving so freely of your time. And I see that Nolan and Casey, you were riveting because we have largely the same audience that has stayed an extra 10 minutes. Thank you both of you for making yourself available. Thank you, everybody. We will send through the CPD points when we get them, and we look forward to seeing you next month for Essentials. Thank you very much, and goodbye.